Let's take a closer look now at how this trade turmoil is hitting the markets, the broader economy, and geopolitical tensions. Joining us now, Stephen Whiting, Chief Investment Strategist and Economist of Citi Private Bank. Tori Smith, a trade economist over at the Heritage Foundation, and Peter Bookvar, Chief Investment Officer at Bleakley Advisory Group and a CNBC contributor. Welcome to all of you. Tori, let me begin with you, and why don't we talk about the latest tariff, and that's the one that the president says he may well put on French luxury goods, from Roquefort cheese to wine, in retaliation for a French tax on American technology products and internet-related products. Unpack this one for me.
Yeah, so what we're looking at here is a French digital tax that was imposed several months ago. And really, the United States has been investigating this tax to see if it's affecting the United States. But the problem is that it's not actually affecting Americans. It's affecting American businesses in France, of course. But that's more a negative impact on French citizens that are using products and services like Amazon, Facebook, Google, etc. And even Amazon has come out and said several months ago, you know, we're actually just going to pass this tax right on to the consumers. We're not going to be absorbing this cost at all. It
affects businesses, but as you point out, Stephen, or she points out, Stephen, these things ultimately come back and are paid in the form of higher prices, usually, aren't they?
Well, tariffs in the United States are paid on Chinese merchandise, are paid by American importers. And if we go ahead with this is $100 billion of taxes that would be collected, roughly speaking, annualized rate from Americans paying for those products. And again, it causes some displacement, but if we weren't collecting that money at all, then there would be no impact. But we are.
But we are. What is your sense of whether the tariffs that are scheduled to go in on December 15th on a host of goods, including now things that really hit home, like my earbuds, my earpods, and so forth, that they will go into effect?
Well, look, I think there's a great deal of suspense about this. We've had delays before. I want to be clear here that what all the news that we can possibly follow, all the experts that we can talk to, we can't know for sure what both sides will do. It will not mean the end for an otherwise underlying healthy U.S. economy and global economy. This has been a weight that has been taken on and off over the course of the last 2 years. If we want to put it back on again, then we'll have to struggle a little bit. But the underlying story is a good one, with low inflation, solid consumers, and a business sector that recoiled, that cut production on the anticipation of an economic downturn here and across the world. And I don't think putting these things or going on again will be decisive in stopping a recovery in the coming year.
Let's talk about that, Peter, a little bit. As you look at the possibility of higher tariffs on Chinese imports, the possibility or really the reality of tariffs on Argentinian and Brazilian steel products, possibly on French cheese and wine. What's the economic impact, if any? Have we felt it yet? Are we likely to feel it in 2020? What does it translate into?
Well, I refer to tariffs as mud thrown into the spokes of business. It doesn't stop the wheel from spinning, but it just sort of clogs it up. And we're seeing in the U.S. contraction in manufacturing, 4 months in a row now is measured by the ISM. We're seeing global trade that is basically not growing at all, and a sharp reduction in capital spending. And yes, the consumer is keeping us alive, and we keep saying the consumer is strong. Well, the consumer is not necessarily strong. Consumer is spending at a decent rate, and that's why we're growing at 1.5% to 2% instead of something faster. But we're threatening the possibility of that consumer no longer being so strong, particularly if those December 15th tariff goes into place on top of the September 1st
goods and hit consumer goods.
Exactly, and that's why I'm pretty convinced that whether we have a deal or no deal, those December 15th tariffs will get kicked into 2020.
So let me put this out here for the table, and Tori, I'll let you go first on this. It seemed to me that yesterday I heard a metaphor that we were inches away from a phase one deal with China. Today, we sound like we're a year away from a phase one deal with China. Is this just negotiating tactics? What are the odds that what the president said today is the master deal maker playing the last innings of this deal?
Well, there's really no telling on when an end will come to the U.S. China conflict. And even this next potential deal is only a phase one, right? And the administration hasn't yet admitted to a tariff rollback included in this phase one deal. So from the American consumer perspective, we're not really looking at much relief anytime in the near future, whether there's a phase one deal or not. Really what this says to me is that the administration's not necessarily prioritizing an elimination of barriers on Americans, and we might end up with kind of a watered-down deal that is more just some things around the fringe and not the core issues.
Tactics or real snag?
Well, look, you heard the Commerce Secretary earlier on saying that you would cede your ability to negotiate if you thought that you were paralyzed by an election. So it makes a little bit of sense. We've seen lots of suspense around this issue, and it can come and go. I think your bottom line here is you have to think about where markets have been. Cyclicals have had a very nice, complete, full circle rebound on the assumption of the things that I said, that the industrial sectors across the world, that the trade sectors across the world have contracted much more than these tariffs would imply, right? So we all rebound, we get very, very confident. Suddenly the news headlines hit us. The reality is I think that we can still actually grow through these tariffs.
So what occurs to me, ladies and gentlemen, is this. On any given day, the market is hypersensitive to a headline on trade, right? Good headline, market goes up.
Especially when we've rallied.
Yeah, and bad headline or questions about it, market goes down. But if you look at the year as a whole or the last 18 months as a whole, all of this trade turmoil has meant very, very little. The market's up 25% this year, Peter.
Right, but underneath the hood, earnings are possibly flat to down this year. So it's had a fundamental impact. Right, but the difference,
That's
though,
exactly
is
correct.
Profit margins are now receding. Okay, so yes, we got revenue growth in 2019, but the profit margin story has completely changed.
So if I've got a market that's up 25% this year, Stephen, and earnings are roughly flat and profit margins are going down, is that a vulnerable market?
The market is not going to be able to repeat the large gain that it had in 2019. We're expecting single-digit returns. We want, again, to focus in on a little bit of the surer part of returns. Dividend income, for example, is a lot more sure. But I think you got to put this in the context of 2 years. 2018, we had a severe valuation contraction, one of the most severe in 50 years. Earnings up double digits, share prices down, right? So this year, flat on earnings, share prices up. There's a middle ground here that I think we're likely to hit, and it's going to depend, in fact, if we swerve away from any massive trade cliff or we don't make any big mistakes in monetary policy. I'm a little bit sure on the latter part, but in the end, I think that we can, in fact, have some gain in earnings, and share prices will basically follow through a bit.
We've got some breaking news. I'm going to cut off the conversation there. Gentlemen, thank you very much. Tori, thank you as well.